a roof don't add to your value because you can't have a house without a roof.
Right.
So even if you got this nice 30-year metal roof, brand new, your value ain't going up. Welcome to the King's Experience. We got my man King. It's only right, you know what I'm saying?
Yes, sir.
To have on the show, my man.
Appreciate you, man.
Hey, man, appreciate you.
Show, man.
Absolutely. It's a pleasure having you here. Obviously, we got my man Jeff from Indy in the building.
Yes, sir. Midwest up here.
You know it.
And I'm the mastermind, Mark Chill, as you already know. But I brought King in because King is an underwriter. And a lot of folks right now want to talk about home ownership. That's right. And I did mortgages, so I did the front end. This is the back end. You know what I'm saying? So we got everybody covered. So if you got any questions, we gonna answer those questions today, I think, right? You know, today, King?
Yeah, we gonna get into it, man.
Absolutely, man.
Like you said, everybody's curious. It's a challenging market right now. But it's a good opportunity to get in. So one of the ways to get in is to be prepared.
Absolutely. You know, and you always get the question, we always get the question, you know, is now a good time to buy a house? You know, should I buy a house right now? Right. And I'm one that's on this edge of like, it's always a good time to buy, because if you're renting, you're not building into nothing. What's your response to, is it right now a good time to buy?
Hey, I agree with what you said, man. Like, my thing is, if you have the money, it's a good time to buy. Like, what else are you waiting for? You know, it's time to get prepared, you know, get into the homeownership game, and, you know, no fear in it. Just get into it.
Yeah. And that's big, is the fear aspect of it.
Right.
You know, I think even for myself, when I bought my first house, it was like, am I doing the right thing? Like, is this right? Is it, like, what's the steps that I'm supposed to be doing? What I'm supposed to be doing? You don't know. Even though I was 5 years into doing mortgages at the time, it was still a scary aspect. So what are some of the things that you see, you know, on the back end that kind of keep people from being able to fulfill the home ownership dream?
Before we do that, explain what the underwriter is.
Oh, yes.
Great question. Great questions for people who don't know, man. So, in simple terms, an underwriter is pretty much like the security wall, the firewall, as you may, for the business, where if somebody's interested in getting something from that business, you have to go through the underwriter. The underwriter is going to make sure there's nothing crazy. We the security guards of the business. So nothing, you can't get through until you get through us. If everything checks out, we'll let you pass. If everything don't check out, we got some conditions that need to be met before we can take to that next level.
I always called you guys the gatekeeper.
I like that.
That makes sense too.
The gatekeeper, because I think there's this misconception, and I spoke to somebody a couple of days ago. They were like, "Well, the underwriters are gonna turn me down." I said, "Nah, man, the underwriters don't turn you down. That's not their job. Like, the underwriters are the gatekeeper.
Right.
They're just making sure that your needs, what your qualifications are, meet the qualifications of whether it be Fannie Mae, Freddie Mac, FHA, what have you, to be able to close the loan."
100%. 100%. Like, we don't want to hold the loan. If we hold the loan, nobody gets paid.
Right.
You know? The business doesn't get paid. We don't get paid. The people that are helping other people get these homes, your realtors, your brokers, they don't get paid. Trust me, we do not want to hold the loan. We want y'all to close. We want y'all to close.
We want you to close quick too.
Right.
You know, because
we want you to close the right way.
Books.
Exactly. We want you to close the right way, because the thing is, on the back end, you know, while you're approving loans and letting people in, there's another blanket of people that's also checking that work as well. So yes, the business is checking, but the business also has to adhere by the investors,
Right.
and the government.
Right.
Because if they're not getting right with the government or the investors, we have a problem.
So when you say investors, right? Because a lot of people might not know,
Right.
What are you
right.
referring to as far as investors?
So for investors, it's your Fannie Mae, Freddie Mac. Those are the businesses, the investors that's pretty much going to, insure your loan. They're going to make sure everything looks good for you. They're going to take care of you. So what happens is when the lender takes in your loan, they also have to take that to Fannie Mae and Freddie Mac so they can make sure you're protected. And also, in addition to those investors, you have the government. So you have FHA, you have VA. The government is automatically going to look out for you as well because they want to be in your best interest, especially for VA. Obviously, VA specifically for veterans. So they want to make sure the lender is not taking advantage of you for just business.
So I think a good thing we should do is like go over the mortgage process.
Okay, that's
Let's go over the
perfect.
mortgage process.
I can go over the whole entire process.
And
Man. Let's see.
we can start. I think we will start from like, what's the very first step of getting a house or home ownership?
The very first step in getting a house, you definitely want to get you a realtor. The realtor is like your pro. That's going to be your agent. That's the one that's going to go for broke for you. That's the one that's going to make the negotiations, talk to the right people. You want to make sure you get your realtor because they're supposed to coach you on what you want to do. So you go to that realtor, tell them what you want, what you're looking for, what's your price range, and you want to make sure they're in your best interest because that's what they're going to get paid for.
Right.
So that's the first step. Get you a good realtor, interview them, be comfortable with them. If you're not comfortable with that realtor, don't go with them.
Yeah, man. Find you another. It's a business. You
Exactly.
know,
Exactly.
They working for you to make sure.
True.
You know, and I say that because when I bought my house, there's some things that like you don't think about, like how fast does the hot water turn hot?
Right.
You know what I mean?
Right.
Where are the vents all connected? So if you got a small house and you got the vents that are connected to each house, you're gonna hear what's going on in each room.
Exactly.
You know what I mean? So there's so many things that you don't think of when it comes to buying a house because you don't know what you don't know.
Yeah, I would
You know
say
what
in
I'm
addition to that, before you even get to the house, you want to know what the location is.
Right.
You know, you want to make sure how knowledgeable is that realtor. You want to make sure, hey, do you know, north, south, east, and west? Like, where's the good places at? Where's the bad places at? How would it fit in my situation with my family? That's the big thing. Then we'll get into the type of house we're looking for.
Right.
For sure.
Yeah,
That's how you know if
absolutely.
you got a good realtor or not. They know the location, and then they know what's your best interest on what type of house you want to shoot for.
They say the location.
Location, definitely location. As we see here.
The school district, like all that comes into mind. Again, those are things that you don't think about when you're looking into it.
Yeah.
So you got your realtor.
So now you got your realtor, and obviously, let's just say you went through the realtor process, you found your home. Now it's time to get into the application part. It's all about finding your lender. So in finding your lender, you can definitely ask for recommendations from your realtor to see what they would go with because they know how that lender works. They know exactly what that lender would need. It makes your process so much smoother. If you have a preferred bank, a credit union, they have better options as well. Do research on that, bring that to your realtor. But now, let's just say we're now in the lender process. We're now submitting the application. So you're submitting the application to the lender. You already have your contract.
Right.
So you already know what house you're shooting for. You already knew what your price range was. You already went through the open house.
You've already gotten pre-approved.
You already got pre-approved. Either pre-approved or you got verified. So now we're in the application process. So we review the application. We review first, last name, social security number. Are you married? I'll get into more of that later. But are you married? Are you a U.S. citizen? We're going through that whole entire workup. Your personal information, learning on where you work at, who do you work for, how long you've been there. If you haven't been there, where have you been at prior to that? Are you self-employed? It's a big thing as well. Or do you not work at all? Do you have disability? We get into those specifics. So we're pretty much doing this work down from like top to bottom on the whole application, and we're taking that, and now we have to back that up
Right.
with your documents. So now we're getting into the review phase. So you pretty much submit your application. Now, after review it, now we're asking for information. So the biggest thing that we're going to check for, we need your credit report. We need to see what's on your credit. The biggest thing in the mortgage process is your DTI, which is your debt to income ratio. Your debt to income ratio is pretty much how it's like it's your health check. It's checking on your pulse. How good is your debt compared to your income? You want to always make sure your debts are low and your income is high. That's why assets over liabilities.
Right.
You want to have more assets, liabilities. That's how you get into the game.
Right.
That's the big thing that underwriters try to check for.
Is there a percentage that you're looking for?
Definitely a percentage.
Yeah,
The percentage
Depends on
on the product.
what product, and when we mean by product, we mean by either is it a VA loan for vets, is it a FHA loan, or is it a conventional loan, which is backed by Fannie and Freddie.
It depends on the product, but I would say a good guideline, and anybody can go by any, guidelines on when they qualify for a house. I would say no more than 50%. No more than 50%, because think about it. If your debt to income ratio is 50%, you're pretty much saying 50% of your money is going to the house.
And that's your gross income.
And that's your gross
That
income.
that ain't your net income. That's your gross income.
Well, except for VA and FHA, and I'll get more into the percentages on that. But yes, it's initially your gross income. So, but even think about it. You don't even get your gross income.
Right.
That's the point.
Right.
When you said that, I'm like, hold on now.
So
Right.
as far as the legality is concerned, 50% is a decent number to strive for when it comes to your gross.
Okay.
Ideally, like if you want to talk like realistic numbers, you want your ratio to be closer to 35 to 40%.
Okay.
Because that's your net income. If your net income is at 35 to 40, then your gross is going to be closer to 50.
Yeah, and even like with the gross, which is obviously nothing wrong with taking it from a gross perspective, but as a buyer, just think about it. Like you don't get your gross, so before you even get a house, like what is your net, and how would that measure to your house payment? Because you still want to pay other things you need to pay for. You still have to pay for bills. Now you get in the house, you have to pay for more than just your bills now. Than the phone bill and the internet bill and trash bill. You got
You got gas
a lot
bill,
more stuff.
you got
Gas
a water bill, you got a sewage bill, you
HOA
got
dues.
HOA dues. If you got an HOA, it's and then one of the most important things as a banker that we look at is our assets. How important are assets when it comes to the qualifying aspect?
Oh, it's very important. Your assets is about as important as your income, because you have to, in addition, showing the lender, hey, I can pay for this loan with the employment that I have. You also need a proof of point, like, hey, I have the funds to not only pay for the loan, but also have reserves as well, because if anything happens, if I can't pay the mortgage, or if I need to have modification, forbearance, you need to have reserves, because you don't want to go under. The lender doesn't want you to go under either, because then they're not going to get paid anymore.
Right.
They still want to make sure you can pay that loan.
There's this big misconception of like the lender's out to get you. Like the lender doesn't want your house.
They don't.
The lender cannot do anything with your house other than sell it. You know what I mean? It's a liability for them.
So maybe
You
that's
know?
the question. Can you just describe that? Give me an asset, give me liabilities, so the people know, like, what's the difference?
So I would say, let's see, like a real life example for assets. I would say one big thing is like real estate. Like real estate is an asset. It can be an asset driven tool that you can use, and it just depends on how you leverage that real estate. Because if you have a piece of real estate, let's just say it's a rental property, yeah, you can make money off it by having tenants, but now what are you doing with that money? Are you spending it? Are you saving it? What are you doing? And the big thing about assets, you want to keep it. Assets is about keeping your money, not spending it.
Yeah.
So you need to have something like real estate to accumulate more wealth, to build up more assets, so you can take that asset, go buy something else with
It's
it.
at least from my opinion, is anything that builds for you, that helps you build. Where a liability would be anything that takes from you. If you were looking at a house builds equity, right? So when you sell it, you can sell it for more. That's an asset. It brings more cash flow to you.
Right, stocks and bonds.
Stocks and bonds, right?
That's another big thing.
Stocks, I mean, they could be a liability too, because if the market drops, so it's a 50-50. But everything, I believe that almost everything in life is either an asset or a liability for you.
Right, and I would say with assets, you want to look at assets long term. Like when you see a lot of like people that build wealth, you know, they have a lot of assets. Like it's long term. It's not a quick, you know, it's not Forex. You know, it's not always your Bitcoin. You know what I mean? Like it's accumulating money over time, and you're keeping it more than you're spending it. You gotta play the long term game. All about long term.
What's the most common reason that you see that people fall out of the home buying or the process of being able to own a home?
Man, I have a lot of reasons. I've seen a lot of stuff. I've seen a lot of stuff. I would say the most common is obviously the income because, mind you, what I mentioned earlier, you want to find that good realtor that knows what they're doing. So when they're trying to get your income calculations together, and if there's, you know, overinflating or miscalculation, that's the big make or break. Because, like, hey, you said you made this amount of money. You actually don't. From your pay stubs, your verification of employment.
Oh, my God.
You know what I'm saying? You already know.
So wait,
You already know what that is.
Are you saying people fabricate their numbers?
Yeah.
People fabricate their
Oh,
numbers, man.
Yeah.
And even like self-employed, sometimes self-employed clients miscalculate their income.
Okay.
And it's so easy to do. It's not anything that's, I don't say malicious. In a lot of cases, it's not malicious.
Right.
And what a lot of people will do is they'll say, oh, well, I make about $60,000 a year. You know, all right, cool, perfect. But that $60,000 may include overtime. And they've only been at their job for 6 months getting overtime.
Yeah. Exactly.
But what ends up happening is that they say they make 60 and they give you their pay stub and they don't tell you that they took time off, you know, back in January, or they had to do what have you. So their income isn't going to match up to what their general annual is.
And I'll add on to that. Another big thing is people, you know, are on leave, especially our ladies out there, you know, maternity leave.
Yeah.
So you can say, hey, I made 60,000, but you look at them pay stubs, the year to date is low. It's like, well, what happened?
Yeah.
You know, and they don't ever mention it's like, oh, I got pregnant. I'm like, that's fine.
Yeah, it's life.
just need
Yeah,
information.
it's life.
There's some things that you can get a workaround.
Exactly.
You know what I'm saying?
Exactly.
But then there's some things that's like, yeah, I just didn't feel like going to work, or I got laid off, and you know, there are some areas of grayness when it comes to that black and white that either Fannie Mae, Freddie Mac, VA are looking for.
Yep.
You know, so we got the income. The income gets inflated. We're obviously looking at a 50% debt to income ratio. What goes on from there, King?
All right, so you got your income now. We're good on income. We got the debt to income ratio. We're good on that. Next thing is the assets.
Okay.
So with the assets, we're checking your bank statements. We need the bank statements. We need to see all that. First, last name, your account number. Don't black it out.
Right.
Don't black it out. Don't try to be like, oh, we're not trying to log into your account. We don't want, we don't want access to your funds. We just need to. It's a transparency thing.
Absolutely.
We both want to be transparent. As both parties want something.
Right. I mean, at the end of the day, you're lending. The lender is giving you hundreds of thousands of dollars. You know what I'm saying? So yes, we're going to look at.
Right.
Everything.
Got like one of the biggest line of credits that you don't get in your life. So like, in checking the bank statements, we usually ask for 2 months of bank statements. The reason why we ask for 2 months is this thing
Looking for
called fluctuation for sure, and then that fluctuation is a thing called large deposits. And that's a big thing that gets a lot of people. So what large deposits are is on the guidelines for every single product that you get with a mortgage, 50% of your income, if there's a deposit that's more than 50% of your gross income, that's an issue. Because we need to see where that money came from.
Yep.
You gotta
So if
source
you're
it.
making, I don't know, let's just say you're making like $4,000 a month, right? And we calculated it, we confirmed it. If I see anything over $2,000, like if you just got a $10,000 deposit, where'd that come from? Why are we asking for that? Because that also reduces potential fraud.
Okay.
You know, because you can deposit cash that you got from under the couch,
Right.
or that you had in the backyard a couple years. It can come from a loan. That's the big thing. If it came from a loan, that's a big issue because it's not your money. You know, now
That goes into your debt to income
yeah,
ratio.
yep, that goes into your debt to income
Makes
ratio. So in checking the assets, we just want to make sure that you truly have the assets that's coming from the work that you're doing,
Okay.
not from weird sources for you to try to pay on a mortgage. Because if you're borrowing money from other people, you know, you're gonna have another liability, and then we're not comfortable that you're gonna pay the mortgage off,
Because you can't afford it.
right? Because you can't. afford it.
Right.
And it happens. We've seen that before.
Yeah.
So we check the assets, make sure everything's legit. Well, obviously we have to make sure you have the closing costs. Make sure you also have enough money for the earnest money deposit. We just want to make sure the assets are covered, like you can actually pay for it. Now, if you don't have the assets, you can technically you can get a gift from, you know, family.
Friends or family.
Friends, family. I think they changed it recently. You can actually get gifts from like the realtor. They can credit you.
Really?
Yeah, they can give you credits. Just like how a seller can give you seller credits now, they're starting to be somewhat accepting like of realtors, you know, doing something for the clients as well to qualify.
Is that just to kind of break this up? Is that also on the closing? They can pay for your closing, is what you're saying?
They can.
Yeah.
Okay.
They can actually help you pay for the closing costs. If you, let's just say you can't qualify to get down payment assistance, or maybe the product that you're qualifying for is a little, you know, too pricey. Sometimes realtors like, hey, I'm willing to pay for that. Or sometimes the realtors is willing to negotiate with the seller, you know, talk to their agent, and it's like, hey, you know, how much is the seller willing to support the buyer? Are they willing to give like $5,000, $10,000? If they work that out, there you go. That just covers some of your closing costs. So now you can take that extra money and do whatever potentially needs to be done to the home, depending on what goes on.
And those are called concessions, right?
Yeah, seller concessions, seller credits is the same thing.
Yeah.
Yeah.
All right. You see concessions generally on the paperwork, so
Exactly.
you know, it's just a credit. It's just a credit.
Simple credit. So yeah, you know, we make sure the assets are good. And then after the assets, I think I mentioned about the credit already, right? Like the credit report. So yeah, pretty much credit report, income, assets. It's pretty much it.
Well, what's the credit need to be?
Depends on the product.
Depends on the product. Depends on the product.
What's a range you would give someone? Are you saying someone walks in the door with 500, you're like, okay, yeah, come on in? Or are you...
The minimum credit score, is that a big
like-
question?
Yes.
The minimum credit
That's
score
the question.
is 580.
Okay.
580 will allow you to be eligible for an FHA mortgage.
Okay.
Right? That's 580. All right, so when it comes to the mortgage aspect, there's only really three types of mortgage you're going to qualify for. It's going to be a VA loan, an FHA loan, or a conventional loan.
Yep.
One of those three. FHA is the easiest loan to qualify for when it comes to your debt to income, the value of the house, your down payment, your credit. FHA is going to be the easiest loan to qualify for. Minimum credit score, like I said, 580.
Yep.
Get you in the door. The reason why FHA and VA loans are so easy to qualify for is because they're all automatically backed by the government.
Automatically.
1,000%.
Yep.
So they already know that they're going to be the ones insuring the note. They already know that the paperwork's going to be good. The qualifications are going to be a little bit easier. On the flip side of that, it takes a lot more for the house to qualify. So what I mean by that is like when they go through to inspect the house, because you got to get a house inspection,
Yep.
and you have to have an appraisal.
Yep.
They go through with a fine-tooth comb to make sure that house is in good condition. Is there any chip paint? Is there any peeling paint? Or is there baseboards that's missing? You know,
Dry
anything. And if there's any of that, it has to be fixed before the loan can be closed.
Yep.
So that's FHA and VA.
Yep.
Conventional is more of a risk-based scenario. Okay, so they're going to look more at your credit. It's going to be harder to qualify on the front end, but when it comes to the house, they really don't give a fuck.
They really don't care.
You know,
They don't care. You know, they be giving out those waivers.
yeah,
They won't even do
get
an
an
appraisal.
inspection waiver. It
Really?
does not matter. Like, if you qualify on the front end, because it is harder to qualify for a conventional loan.
Okay.
They want your credit to be in a higher standard. So
Now, what's a higher standard?
higher standard is based off of pricing. Okay, ideally, you want to be above 720.
Okay.
But at a bare bones minimum, You want to be above 680.
I was about to say 680 was definitely. I was like 680.
680 is the bare bones minimum for a conventional loan, because what ends up happening is, with it being risk based, if you have shitty credit, if you have a low down payment, if your debt to income ratio is going to be a little bit more tight, you're going to pay a lot of fees to get that loan. It's going to cost you a lot to close that loan. So they're going to charge you more to get that loan if you have a shitty profile. Where FHA and VA, it's what you see is what you get. Your 580, your 620, as long as you meet the guidelines or what have you, then you're not, your cost is what the cost is.
Right.
Where a conventional loan is based off of all the other parameters, the credit, the property, the income, all of that plays a factor into how it's going to close and what it's going to cost you to close. I like FHA loans personally because they have one of the cheapest down payments if you're not a veteran, 3.5%.
About 3.5%. But technically, for a conventional, if you're a first-time home buyer, you can put down 3%. Because when I bought my house in 2021. And I took advantage of that. I was
Really?
like, I'll do the minimum 3%.
Now, hold on. So they know, when you're saying 3% of what?
3% of the purchase price.
The purchase
So
price.
whatever the purchase price is, take 3% of that. That's your down payment. But I always recommend you can always make the down. You don't have to stick to the 3%. Usually people think you have to put like a big fat down
They
payment.
think you got to put 20% down.
Yeah,
Of course.
like-
Yeah, that's the hearsay. That's the
Yeah, and
Yeah,
the
that's
reason
what discourages a lot of people.
the reason why it's here is because 20% is the number that gets you away from having to pay mortgage insurance in most cases.
PMI.
PMI. Now, 3%, you're going to pay PMI. 3.5%, you're going to pay PMI. Both my houses, I did 5% down, lender paid mortgage insurance. You take a slightly higher interest rate, slightly, like an eighth of % higher, but instead of you having to your payment being $150 to $200 higher on a monthly basis, you don't have that extra fee that's coming out of your pocket.
Does that person that has the 580 credit score qualify for that?
No, that's only on lender paid mortgage insurance is only on conventional mortgages.
Just so we're clear.
Yeah. So if you do an FHA loan, that's a great question, because if you do an FHA loan, you're going to have mortgage insurance no matter how much of a down
Regardless.
payment.
Yep.
No, if you could put down 50%, you're still going to have PMI, and that PMI is going to stay on your loan for 11 years, a minimum of 11 years, or until you refinance it to a conventional mortgage.
Right, and I think for conventional, if the LTV, which is the loan to value, so whatever the loan amount is compared to the value of the home, if that turns, eventually when you're paying down the mortgage, if the loan to value percentage is 80% or lower, the lender will actually take off that PMI if you're on conventional.
It'll fall off.
Yeah, they don't really tell a lot of people that.
Yeah, on a conventional loan, the mortgage insurance will fall off once you get to the 20%, 22%.
Okay.
Yeah, it'll fall off on its own. Where FHA is going to be there no matter what. As long as you have that loan, that PMI is going to be there.
Yeah.
And you have to refinance to get out of it.
Okay.
Into a conventional mortgage. You have to refinance into a conventional mortgage
Gotcha.
to get out of mortgage insurance.
So we went on the whole.
That's the process, man.
Yeah, that's the process.
And then, I mean, I think that a lot of people, one misconception is that the appraisers work for the lenders. The appraisers don't work for the lenders.
They don't.
They're their own entity. We, as a matter of fact, you pay them.
Right.
You pay them to come out and appraise your house. So if there's an issue with the appraisal, you see the articles about, this couple that had the crazy value, and then they got another appraiser to come out and it came back so much higher.
Yep.
That's because that's what appraisers do. Like, every appraiser is not going to give you the same amount. That's their job. Like,
It's all based off of their
Training.
training and also like what's being sold at the time. Because if you find 3 houses that are similar, and some appraisers are just shitty appraisers, we got to call a spade a spade. Some appraisers are just shitty appraisers, but it's generally based off of the comparables in your area that are most similar to your home.
You have square footage, right?
Okay.
Yeah, amenities, like if do you have a pool? Do they have a pool? Those types of things. If you upgraded the refrigerator and the stove, it looks nice, but it don't add to your value.
Is that because everyone doesn't want that? Like, you're adding something for your own eyes, opposed to someone else's. Someone else comes in there. I don't want that. I don't want my house to look like that.
I mean, unless you got
Is
like
that kinda what we're looking
gold faucets and gold, toilets in your house, then and the house across the street it has the ceramic joints.
Right.
It's the luxury item that's for yourself.
Okay.
If you put on a new roof, guess what? A roof don't add to your value because you can't have a house without a roof.
Right.
Even solar panel. Oh, yeah.
Solar panels don't add value.
Heck
Really?
No, they can't play that game. I'm glad you mentioned solar panels.
Mm-hmm.
That's another thing that gets buyers that I did not
Oh, yeah.
mention is solar panels.
They're great selling features.
Very great.
The gold toilets, the marble counters, the nice floors, those are great selling features.
Exactly.
But they don't add value to the house. Because if the exact same house across the street sold for $330, is the exact same square footage, the exact same bedrooms, and they don't have the marble and all that, guess what? The value of the house is $330.
Exactly.
You know.
And I would say like you have to look at it like look at the things that you can't take out the house, like the foundation. You can't move the foundation. You
Right.
can't just up and move the house. So like think of
Okay.
things that you touch that you can't move.
Okay.
Yeah.
That's what they really going off on.
Yeah.
Like you
If you
said.
if you change the flooring will add a little bit of value to the house.
Yeah, they would.
Changing
Exactly.
floors,
Changing floors.
kitchen.
Kitchen.
Kitchen is one of the biggest ways to add value to your home is renovating the kitchen. So those are things, but like the appliances, the stuff that you could take out of the house if you wanted to, unfortunately there's no benefit. We talked a little bit about closing costs,
Right.
but I don't think we actually went super in depth on it. I know you work on the back end, so maybe that's more of a question
Well,
for
no,
me.
I know for sure, like, because trust me, I was going through the loan process too. Like, I know what it's like, so I was doing the research.
There we go.
Like, okay, what's this and that? I think for closing costs, I think the percentage is like 3.5 to maybe like 5%.
Yeah, it depends on your rate.
Yeah, it does
Clo-
depend on the rate. You're right.
Closing
It does depend on
costs,
the rate.
closing costs and rate they coincide with each other. I equate closing costs to a sporting event or a concert. Concert's better, right? You could go to some no-name artist, right? Your seat, the cost for your seat is going to be super cheap, right? The seat is the interest rate. The better the seat to the stage, obviously, the more expensive that it gets.
Right.
The nosebleeds are going to be a bit cheaper, obviously. So you go to some no-name lender, right? And their closing costs may be super duper cheap. However, it might take them 3 to 4 months to close their loans because what closing costs pays for is not just the lender's fees. It pays for the third-party costs, the appraiser, the title work, the underwriting. So if all of that is not done in-house, then they have to pay somebody to do it, and it has to be done. Ain't nobody in the history of business not making money.
Yeah.
Right.
The cost of closing really depends on the rate that you choose, and the rate that you choose is going to be based off of your qualifying, parameters.
And I would say at the same time, like you mentioned, that was a good analogy about, how to look at it at the closing costs. Because, like you said, you can have nobody never heard of this bank before, credit union, cheaper closing costs. But at the same time, in the same effect, it's not always best to go to like the best bank.
No, it's right. On the flip side of that, you saw those. Beyonce just came out, right? You saw those tickets for Beyonce. That's astronomical costs.
But you can't you're not saying I can just show up to a bank tomorrow that I don't have any affiliation with, and they're just going to automatically give me a loan. We're talking about more. I'm assuming maybe credit unions are going to have the better rates. That's my guess. They're a little bit smaller.
The rates, no lender's going to have a better rate.
Okay.
Because the rates are regulated.
Yeah.
Okay.
And I was gonna say like when it depends, it just depends what are they offering.
Right. Like when it comes to interest rates, and this is a big misconception. They think that, this lender gave me this rate. Every lender can give you the same rate. There's a range of rates. And depending on what the bond market does is going to depend on if that rate's high or low. Think of an interest rate like stocks.
Okay.
Yeah.
Interest rates are just like stocks. And on any given day, the price of that stock can be higher or lower.
Okay.
Depending on what's going on. The jobs report comes out and it comes back better than they anticipated. Okay. Rates go down. the global economy does have a factor on the interest rates, but there's not one lender that can offer one rate that another lender can't offer. The cost of that rate might be different. You have certain fees that you have to pay for when it comes to your mortgage. You have what's called your origination fee, which is what the lender actually makes. That's the lender's cost for redoing your loan. That's what they make. Outside of that, you have your third party fees. So that's the only fee that the lender actually makes. The lender, the origination, and the discount points. If you're paying to buy your rate down, if you're paying for that better seat. Okay. Other than that, everything else is third party costs. Your appraisal, your title work, insurance, title insurance, all of that jazz is all third party fees. From there, it depends on like where the market is, when you decide to get in. It's kind of like a timing thing.
And again, like I mentioned earlier, man, get you a real good realtor because they would know what they can and what they can't do if they have a preferred lender. Some realtors, they can, talk to the lenders like, hey, could you waive the underwriting fee? Or could you, put that on me, like charge me for that, I'll pay for it for the buyer, It just depends.
That's a good real.
So, hey, I've seen it. I've seen it, man.
Realtor.
I've seen it. I've seen where some realtors like, hey, I'm gonna pay for this. Like, don't
Really?
worry about that. I'm gonna make the cost cheaper for. Like, okay.
Yo, find that realtor.
If that's so, that brings me, I guess, to another question. How do I find a good realtor? How do I know who's a good realtor? I guess that subjective. Could
Word of mouth.
Word of mouth. Yep. Referrals. Referrals is a big thing. See if you can talk to, if you have a friend, family, they recently bought a home, or anybody that that bought a home, just ask them like, hey, do you have a referral who I can speak to on the home buying process? How did you like the experience?
That's a great question. Like, what was your experience buying the house?
Okay.
Because everybody's experience is going to be different based off of one, their lender, and then also their realtor. It can make the home buying process very difficult.
Right.
'Cause you gotta look at all these houses, and you're like, this is not what I'm looking for.
Right.
So that I think that brings me to my point was, like, have an idea of what you want when it comes to buying your house. Because if you don't, and you leave it up to someone else's interpretation, they're going to show you all types of shit. They're just going to show you what falls within those parameters.
Exactly.
And time is money. You don't want to spend a whole Saturday driving around looking at 4 houses that none of them match.
So wait, you saying me open house? I can't go to open houses?
Yeah, you can.
You
do
can.
open houses.
You can go to open
do
houses.
open houses. Like we've did it before.
Yeah.
My wife is over here. Everybody, we've went to open houses and we didn't have a realtor. It was like, all right, we gotta go get a realtor, man, because like we walking in here, we really doing. We want to know the lingo, so we need to find somebody that know it.
Yeah.
You know what I'm saying? And then that changed the process because when we did get a realtor, boy, he went to work.
Okay.
Every time we went to open house, he was like, y'all go look at the house. I'm going to go talk to the sellers. And I'm going to get that information. And boy, did he get that information, because that helped us decide whether we want to buy or pass. Make the process so much smoother.
So you're saying that you're looking for a realtor that is one for you, two who's going to work for you on the back end, where, like you said, you're just looking at the house, he's doing the back end work, but you see the work and you see the movement. If you don't see the movement, maybe this is a bad realtor.
Exactly. And there's nothing wrong to, it's y'all are a team,
Right.
They are on your team. You got to, when you buy a home, treat it like a business, put your team together, because with the realtor, man, that they're supposed to have the most experience on this home buying process to get exactly what you need. It's the biggest investment you're going to make. One of the biggest investments you're going to make in your life is buying a home. You don't want to go through that bad experience and then get stuck in a home you didn't even want.
Right.
With a payment you got to pay on it.
Okay.
And I would just imagine you trying to sell it fast. Like, you don't want to just quickly live in a home and quickly sell it, man. Like, that's not going to build anything for you.
Yeah. It's owning a home is like you said, it's a long game.
Yeah.
And what I mean by long game is anything that's minimum 3 years. because you're not going to see much of any growth within those first couple of years of just being in the house.
Right. So as we mentioned earlier about the realtor, like, ask for referrals, ask how the, experience was,
Okay.
collect a little a roster, see like, okay, I spoke to this person, that person, this person, I think I'll either give this realtor a call. I would say in addition, specifically, there are some lenders that they do partnerships with realtors.
Is that a kind of a conflict, or is
No,
that?
it's not a conflict. It's not a conflict because that's if that lender already made that business. But some
Gotcha.
lenders can do a partnership, or they can have a business that has those team of realtors, so they're all working towards the same goal. It's just like a realtor has a preferred lender; they're pretty much doing the same thing.
Absolutely.
Right.
Exact same. But definitely getting personal is probably like the number one option first.
Yeah.
Check to see what's going on around, like your family, friends, see who they worked with, talk to that realtor, that agent, pick their brain, see what they know. If that's the person for you, put them on your team.
Okay.
And get the process started.
Yeah, man. Everything surrounds. We talked about that a couple of weeks ago. How important having a team is.
Right.
Because the thing is, we don't know everything. So there's always someone that you can add to the bunch that may pick up on some slack that you didn't know of.
Yeah.
Or, teach you, I put that in my business. Okay. I like it.
Right.
Absolutely.
I like it.
What's the closing time right now from start to finish? What are you seeing?
It depends on the product. It depends on what happens, but
Okay, let's break it down. So for a conventional loan, normal loan, conventional.
conventional is about, say, like 20
days?
20-ish.
Okay.
20-ish days, like around the 20 range.
Okay.
You'll be shocked if it's actually done faster. But if it's done faster, like within like a week, that means that realtor knew exactly what to do. And they pretty underwritten the loan before it even got to underwriting. So they already knew what was going on. They was probably already sitting on that deal.
Yeah.
Loan close that fast. They knew exactly what they was doing.
Okay.
So let me ask this then, to kind of just to tie things together. So we live in a place now where we see houses going up all the time.
Right.
Like they're like weeds coming up. Are you saying that the realtor most likely has a plot and they know this area is going to sell, so they're invested in this area and the listing pops up, or they already have houses that are already built and they're saying they're getting people that come to them saying, hey, this is the house. I've already written everything up because I know this house in and out. Is that what you're saying? Or
It depends. Everybody's a little different. I would say from my experience, personal experience, what would happen is that my realtor had, he already had a template for like drafting contracts if there was a house we were interested in.
Okay.
So if we wanted to put an offer in there, he already had somebody to just go ahead and curtail that contract. So they already have like things in place. I would say for like realtors, they have the map.
Okay.
Yeah.
They have the map, and with you being a buyer, like you want to utilize their map so you can know exactly where you need to get.
Right.
So you don't get lost.
It also depends on the location too. Going back to location, because that it might be a new development or a relationship with a builder, it might not be in the location that the buyer wants to live in.
True.
Okay.
So that plays a huge role into things too. Like I said, you're going to give the realtor the instructions on what you want and what you're looking for, and then from there, it's going to be their job to find what you're looking for in the area that you're looking for. Put the puzzle pieces together, so to speak. All right, so you got 20 days on FHA.
Well, not FHA.
I'm sorry, that's more conventional. I'm sorry,
like conventional, like 20-ish. For BA, how many days? It's somewhere like I would say in the 20-ish range. If it's past 20, if it's past a month, the reason why primarily is because of the property itself.
Okay.
Like you mentioned earlier, it's all about the property with government, like with FHA and VA. So, like you mentioned, if there's an inspection that takes place, and if that inspector, he finds stuff, they got to fix that.
Okay.
But you're not moving. So primarily it's been the appraisal repairs that's been holding back the buyers, and in addition to the appraisal repairs, there's a thing that VA specifically does: pest inspections.
Right.
They got to make sure there's no termite
Termites,
damage
yeah.
Okay.
or anything. So you have to get a termite expert to go out and do the whole entire work. If they find
Okay.
even the smallest little thing and they recommend that, that has to be done before you can close.
If they put anything on those reports, man, once it's on those reports, ain't no coming back from it.
So
Nope.
There's no
It's
switching.
solid.
There's no switching programs. Like
Set in stone.
it's there.
Yep.
are
You
those
know.
the hardest loans to go through, the VA loan?
It's not the hardest because with VA, the real highlight for VA is, for one, they're looking out for their veterans, and in doing that, they finance the loan 100%. So meaning you don't really have to pay anything out of pocket. You don't have to bring a down payment for
Right.
VA.
Right.
You don't have to bring 3.5% like FHA. You don't have to bring anything. They'll cover it 100%.
You just gotta pay your closing costs.
Yeah, you just gotta pay the. It's called a funding
The
fee.
fund or the
Funding fee is on top.
On
like
top of the
addition-
closing
yeah,
costs.
that's true.
Yes.
That's true.
if you're not disabled. If you're not disabled, you have the funding
Exactly.
fee. If you are disabled, there is no funding fee.
100%, exactly. So with VA, it's easy if you can get your assets, credit, and income right. If you get those right, you're
good.
And you just hope that the property inspection goes well, the termites, like all
Right.
that goes well. You out of there, man. But if I've seen it over 20 days, it's because appraisal repairs, termite repairs,
Okay.
Oh, okay.
or the appraised value goes low, because that's been a big thing in this market. The appraisal value.
Really?
Mm-hmm.
The appraisal value. So what happens, VA, if VA is financing it 100%, and now the appraisal value comes in low, now you got to bring the loan amount down. Now that's going to mess up.
Either one or
whole
two
bunch of
things.
things.
Yeah, either one or two things has to happen. Either one, let's say you, for the sake of round figures, let's say you put in an offer at they were asking for $100,000 on the house, and you were like, okay, cool, I'll pay $100,000. So you sign a contract for $100,000. The appraisal comes back at let's call it 80. Let's say the value of the house is only 80,000. You have one or two options. Either A, you have to bring 20 grand to the table because they're not going to finance a $100,000 house when it's only valued at 80. Or two, you have to renegotiate the contract or get the seller to sell the house to you for 80,000, which some sellers won't do, because they want that cheese. But when you go through that, now that's another hurdle that you have to clear to being able to close on your home.
I've seen contracts canceled because of that. If there's no agreement, it's like, I don't want to buy.
Yeah.
You just keep walking.
Yep.
And the highlight for that, when you do that with VA, you can get your earnest money deposit back because there's an amendment for VA to where when you sign that contract, VA still wants to protect your interest. So if something falls because like the appraisal value or anything that was found, if you don't agree with it, VA is going to make sure you get your money back, get your earnest money, and go find a next home.
So you mentioned earnest money. What's the earnest money deposit for a VA loan?
So like what's the standard for it? Or like what's the general, what's the EMD?
Yeah, generally.
Earnest money deposit is pretty much you're promising the seller like, hey, I'm going to buy this house within like a certain time frame. So in doing that, I'll give you $2,000 right now to hold on to that promise.
So
And then they pretty much kind of either if you don't meet those requirements, they take your money. They take the earnest money deposit because you didn't follow through on that promise. You didn't follow through on closing within that certain time frame. But yeah, that's technically what the earnest money deposit is. You're pretty much making a promise to the seller that you're going to follow through on this deal. That you're going to purchase their house.
Now, can you get those funds back on any other reason outside of the appraisal coming back, as far as earnest money is concerned?
Have I seen anything? I haven't really seen it before.
Really?
I haven't really seen it, but what happens is that on the VA amendment to purchase contract, the sellers also have to agree to it, so they also have to sign that too. So if they signed it and something happens, hey, you signed that amendment. You got to give them that earnest money back. That's low.
Okay. Okay.
And the realtors are going to make sure it's like, give them their money back.
Okay.
So they can go look for the next home. But primarily it's supposed to protect them if like, the big one is the appraisal value. If the appraisal value comes low or anything, doesn't look right initially, then they can get the earnest money deposit for that undisclosed reason.
And you would only put the earnest money down after you actually have a pre-approved or verified approval.
I would say when you made an agreement, like if the seller accepted your contract, then you can, I think that it can go either way. I've seen changes where sometimes they did it in the loan process.
Really?
They changed up the earnest money. Yeah, I've seen that before. I actually seen where the veteran, he did initially put an earnest money deposit down, then the realtor renegotiated it. He actually got it back, and then he got some money back.
Really?
Yeah. So you can do it either process.
One thing about VA loans to be mindful of as well is that there's a minimum time frame that you have to be in the reserve for to qualify for a VA loan.
That's true.
Do you know the time?
It's 6 years.
All right.
You can't just be like, I'm in the reserve and I get a VA. Like,
You have to be in the reserve for at least 6 years, and there's a certain amount of points that you have to get to be eligible for a VA loan if you're in the reserve.
Okay.
Yeah. If you're active duty, full boat.
Are you?
Yeah, you're
Day one?
No, I think you have to get through basic.
Yeah, you got to get through all the usual. You got to get your rank.
Yeah, you get your rank.
Okay. So someone, let's say, we're going to speak to our community now. Someone who's like, I want to buy a house. I don't know the first step to take, but I know I want to buy a house. What do they do?
Call somebody.
I'm about to say,
Who do they call? Who's somebody?
call you realtor. Find a realtor. Talk to the realtor.
You can call a realtor. You can call a realtor. You can call a mortgage lender.
Yeah, the mortgage lender. Yeah.
Right, because you don't want to waste your time. Is the main thing. And the reason why I say call a lender first is because you don't know that you even qualify to buy a house.
That's true.
Okay.
That's true.
If you don't qualify for buying a house, you're going to jump through all these hoops and waste all these other individuals' time on something that you can't even get into. Two of the main reasons why people don't qualify is either because of their credit or their income. There's a lot of different programs out there that will help with like the down payment assistance or the aspect of qualifying for it, but you have to go through those channels to make sure that you qualify for those.
Yeah, you gotta go through their rules.
Yeah, not all lenders accept those programs.
That's okay.
So you'd have to whatever the program is that you're looking at, you'd have to, like you said, follow those guidelines and jump through those hoops to make sure that one, you qualify for it, and two, most importantly, the loan will close.
Okay.
Yeah.
But the very first step would be calling a lender, or hell, if you want to even go even further than that, check your credit.
That's true. Please check your credit.
Check your credit. And not through Credit Karma, okay? Check your credit.
Yeah, you can get a free credit report once a year, right?
Once a year.
You're supposed to.
Right.
But a lot of people don't. But I mean, do they even know how? Do you know how to? How would they do that? How would they
You can go to any of the three bureaus. You go to Experian, Equifax, or TransUnion and request a credit report. When it comes to qualifying of a mortgage, the lender's going to use the middle score. So if you're three scores, you have three credit scores: Experian, TransUnion, and Equifax. If you're, and just for the sake of ease, if your three scores are 10, 15, and 20, 15 is your qualifying score, just because it's the middle score, right? So that's the number that they're going to use.
Be mindful. In addition to that, if you're getting a loan with someone else. Their credit score is coming to play. So if you ball it in the 700s, but they down in like the 500s, guess what?
That's their qualifying score.
So there's not an average. You don't take an average of the two.
It's
at the lowest.
Some programs you can now.
Oh.
Some on a conventional loan, they will average the two out, but it still has to average to 620. So if you had a 7 whatever, and they had a 500, and your score is below 620, then you out. Yep. And that's going to, in reality, it's going to fuck up your pricing anyway.
Boom. That part.
Because you're qualifying off of this lower credit score. You'd be better off just doing it on your own, unless you don't have the income.
Right.
Okay.
So I mean, there's a lot of ways to be able to get into the house. It just depends on really what suits you the best.
What about self-employed clients? 'Cause we know-
Oh man! Whoa! Wow!
Because I
King, you
think
brought
people
up a
need to
big
know
one.
that, man. I think because we there are clients out there that are self-employed.
Yes.
And some of them think they can't do it. When,
For our entrepreneurs out there.
yes.
All right, King. Let's go over.
Let's get it.
Credit plays a factor. It's all the same. Whether you work in a W-2 job or you're self-employed, that don't matter. All right, let's get into this income for self-employed people, because that's where the self-employed clients or the entrepreneurs tend to get hung up at. Let's dive into that. What is the issue when it comes to, what are we looking at when it comes to an entrepreneur's income?
So, from the underwriting perspective, telling you what I see. Get the loan just like the regular process. Now you find out this client is self-employed. First thing I need your tax returns.
Okay.
I need your 1040s. All the pages, not just, here's,
Business and personal.
I need every.
All
give
of
me
it.
all the
All of
pages.
it.
I need all of them. We usually request, it depends on the findings, depending on the product. 1 to 2 years of tax returns is needed.
Okay.
Because what happens with that is we pull income from those tax returns. We pull the income from those tax returns. So please find a really good CPA that knows what they're doing.
Okay.
Please find the right one that knows what they're doing. I've seen issues. But when we look at those we pretty much doing the same thing like with W-2 clients. Like we're looking at your gross, see how much you made beginning of the year to the end of the year. And we don't take anything else. Like, I need to know if your business is real. I need your business license. I need your business license.
Okay.
I need to know how long you've been self-employed for.
Okay.
Why? Because there's some products that require you to work self-employed for a certain amount of,
Ooh.
time.
Ooh,
So
okay.
it's considered actual income.
Right.
Because it's more riskier for a self-employed client than W-2. We don't know how you do your work process. We don't know how you operate your business. Things could be good, and then when it gets bad,
Oh, it's bad.
now it's like, you said you made this much money, now you can't even pay the mortgage. What's the problem?
And for self-employed clients, we actually look at your net income.
Definitely not.
We don't look at your gross. And the reason why that is because you have the ability to write off so much. It's great when it comes to the IRS, but when it comes to applying for financing, it makes it so much more difficult.
If you're doing FHA or VA, a GEM is this thing called residual income. Residual income is pretty much the actual net income that VA and FHA will calculate. So for self-employed, they believe they already did all that already. Well, VA doesn't see it that way. They still look at it as the gross. So they still need to treat it as if you're W-2.
Large purchases.
Right.
And that's one thing that we would tell clients after we got off of the phone is like, hey man, don't buy nothing. All right.
Oh, that's across the board.
Don't buy
That's
nothing.
across the board.
How often do you see that? What is your intake on that?
I see it on a quarterly basis.
Okay.
There's always one person every quarter of the year is like, come on.
What are they buying though? What do they buy?
Cars.
Anything,
They
man.
opened a credit card. So I just had one 2 weeks ago, and it was like a $800 credit card payment. Not even a car. I don't even know what they
Really?
bought. And I was like, what did you put on credit where it's $800 a month? So I'm like, I gotta call the realtor. They decided just to pay the whole thing off.
I got one more. Bankruptcy.
Depends on the program.
Depends on the program.
And depends on the chapter. So for chapter 7, if memory serves, correct me.
I know it was like
You have to wait 4 years from the discharge date. For chapter 13,
2 years.
on FHA, it's 2 years.
And VA is the same.
And VA is
the
2
same thing.
years.
Yep.
2 years from the discharge date.
So I'm assuming, and I don't remember either. 13 is the one where it wipes everything. 7 is the one we're still paying.
7 is when they wipe everything out, which is it's a 4-year time frame.
Okay.
Chapter 13, it's generally a 5-year repayment,
All right.
and until it's discharged. After the discharge, once it's discharged, it's 2 years from the discharge date for
But
FHA.
Is the rule of thumb that if you have a bankruptcy, you don't try to get a home loan. I mean, I know things happen in life.
Not within that time frame. You're not eligible to.
Time frame.
It's a process. Don't get it wrong. It is a process. However, it is not. I mean, so many people do it. It's not an impossible process. Like King said, reach out to your realtor, reach out to a mortgage professional. I mean, and do your research yourself on your situation. Pull your own credit. And that way you at least have an idea of what needs to be done and where to go. You know,
No large purchases.
no large purchases.
No
Right.
large deposits.
Right. No large deposits. All right, man. We got my man King Wilson in the building.
Appreciate you, Mark.
Hey, man. We appreciate you.
Appreciate you, bro.
You got it, brother.
Yeah.
Sir, this is good, man.
Thank y'all for joining in with us. You know what I'm saying? We'll see y'all in the next one.